Optimism, that's a good thing, right? At least that's what we're told. Personally, I think it's healthy to have an optimistic outlook. But sometimes misplaced optimism can set you up for disappointment. Case in point, currently there appears to be a high level of economic optimism in the markets. But what does history teach us about the implications for stock market returns when there's high levels of economic optimism? So to help with the heavy lifting on this question, I'm going to use an article from John Hussman of Hussman Funds. In this case, his weekly market comment from Monday, February 20th. And if you want to know more about who John Hussman is and why I like his work, check out the first few minutes of my previous video on Hussman from September last year. So Hussman starts his latest missive with the following quotes. No Congress of the United States ever assembled on surveying the State of the Union has met with a more pleasant prospect than that which appears at the present time. There can be little argument that the American economy as it stands at the beginning of a new century has never exhibited so remarkable a prosperity for at least the majority of Americans. We believe the effect of the troubles on the subprime sector on the broader housing market will be limited, and we do not expect significant spillovers from the subprime market to the rest of the economy or to the financial system. Now, if you're not chuckling to yourself about those quotes, if you don't know what they have in common, then you should find this video instructive. And even if you do know, I hope you get something out of it. So Calvin Coolidge's comments were made about 9 months prior to the biggest stock market meltdown in US history that resulted in the stock market falling 89% over the course of about 3 years, and which obviously coincided with the Great Depression. Now, the old maestro's comments were made just 2 months before the dot-com boom went bust, and the stock market was cut in half, whilst the tech-laden NASDAQ index lost 83% of its value. And Bernanke's remarks were made 6 months prior to the beginning of the most recent bear market that saw the stock market fall by more than half, combined with a financial crisis and the worst US recession in 80 years. Then Hussman gives us this quote. Investors haven't been this optimistic on the global economy since 2011. A full 23% of investors expect an outright boom, according to a survey released Tuesday by Bank of America Merrill Lynch. The US economy is not only humming on all cylinders, but in our view the optimism associated with a clean sweep by the Republicans in Washington is likely to create a self-fulfilling period of strong markets and at least the potential for strong growth. The optimism comes amid forecasts global growth will pick up, and as Donald Trump promises to cut taxes, boost fiscal spending and loosen regulations in moves that could boost corporate earnings. Macro optimism is surging, wrote the team. And that's from Bloomberg, February 14, 2017. Now, before I go on, I'm not saying that this isolated comment means the same thing is going to happen this time round. I'm suggesting that it's worth paying attention to. As Hussman notes, the relationship between the economy and the stock market is a study in contradiction. It's precisely when economic optimism is strongest, when caution is seen as misguided, and when bullish enthusiasm is most exuberant that the stock market reaches its speculative apex and becomes most vulnerable to collapse. It's precisely when economic pessimism is most dismal, when hope is set aside, and when bearish consensus is most dire that the market plumbs its deepest lows and carries the greatest potential for future returns. So given the backdrop of economic optimism, how does the stock market stack up today? Well, if you ever listen to financial market commentary on any given day, you can find some so-called expert that'll tell you that the stock market is overvalued, and another, armed with the exact same information, will tell you that it's undervalued. The reason I pay attention to Hussman is because the valuation measures he identifies have correlations of between 90 to 94% with subsequent market returns over about a 10 to 12 year time horizon. Or put another way, based on those valuation measures identified by Hussman, you can forecast with a high degree of accuracy the level of the stock market 10 to 12 years from now. As you can see from this chart, the measures that Hussman identifies show the stock market to be between 100 and 150% overvalued, or between 2 and 2.5 times their historical norms. Note that the only other time in the last 70 years valuations have exceeded this point was in the late 90s dot-com bubble, which resulted, as predicted by Hussman at the time, in negative returns over the subsequent 10 to 12 year period. Now, I was an assistant stock market analyst back in 2000, and if you had forecast at the time that the market was going to be lower in 2010 to 2012, you would have been laughed out of the room. And yet that is exactly what happened. And it's not much different from where we are today using those same measures according to Hussman. Quote, "Presently, we estimate that the nominal total returns of the S&P 500 index are likely to average less than 1% annually over the coming 12-year horizon. Since that estimated return is positive only because of expected dividend income, we expect that the S&P 500 index itself is likely to be 10 to 20% lower than its present level 10 to 12 years from today. That outcome would be quite similar to what we accurately anticipated and observed following the valuation extremes in 2000. So think about that. Today, the S&P 500 currently sits at 2363. So Hussman is forecasting an S&P 500 index of between approximately 2125 and 1890. Run that forecast by anyone in the business today, and they'll probably dismiss it as extremely pessimistic, even kooky. Yet that is what historically informed valuation measures are indicating. Now note that just to return to stock market valuations to their historical norm in the post-war period, the stock market would have to fall 60%, more than it fell during the financial crisis. Now all this shouldn't be taken as a sign that a collapse is imminent. These valuation measures are not good short-term market timing signals. So could this bull market continue for weeks, months, or even years? Yes, it absolutely could. But what you need to bear in mind is that the more extreme this bull market becomes, the larger the eventual losses will be when the inevitable fall comes. Hussman also talks about the tendency of investors to chase performance in the final stages of a bull market for fear of missing out, something that appears to be playing out with regard to the shift to passive funds from active funds. Quote, "In general, active strategies compare poorly with their passive peers when the passive indices themselves are at bull market highs. The pattern then tends to reverse in declining markets. Suffice it to repeat that we view the recent shift of investors towards passive, price-insensitive investment strategies as a form of late-stage performance chasing. While that has uncomfortable short-term effects for value-conscious investors, particularly across hedge strategies, that behaviour has historically set up the very opportunities that disciplined, long-term investors rely on." And just as a side note, here is an admittedly very anecdotal indication of optimism often seen at bull market peaks. And this comes courtesy of Jared Dillon, who writes a column called The 10th Man. And he talks about Jay-Z's recent decision to launch a venture capital fund. Quote, "Jay-Z could be a genius for all I know, but usually when musicians and celebrities start getting involved in markets, all hell breaks loose." So I know this is not my usual type of video, but it is something that I've been personally interested in for 20 years or more. I used to work in the industry, but let me know what you thought of it down in the comments below and whether you'd like to see more of these type of videos. And don't forget to like and do all that other good stuff. See you next time.